Retirement obviously has significant advantages. You don't have to work anymore. You have time freedom. You can travel, spend more time with family, friends, pick up new hobbies, whatever it is that you want to do, but you are finally able to execute on it because you have the time. But there are also significant tax advantages in retirement, especially early retirement. And in this video, we're going to talk about 3 strategies for you to consider in the event you're retiring before starting to collect Social Security. This specific time is referred to as the income tax valley. It's the years that are early retirement before you start collecting Social Security, perhaps maybe before you start collecting a pension, and before you are forced to start taking distribution from retirement accounts. And we're going to talk about 3 strategies to consider to realize income while your tax rate is lower. Let's look at Theo and Cassie's case again. So they're planning to retire within approximately 10 years, and we're already starting to look at this income tax valley. You can see in this chart, their projected tax liability goes from well over $100,000 to basically zero when they first retire. And then you can see as they start to collect Social Security and then require minimum distributions, which by the way are when you're forced to take distributions or withdrawals from tax-deferred retirement accounts. So you can see that there's this period of time or a valley where their income tax liability is projected to be zero because they have not started to collect Social Security or not taking retirement withdrawals yet. And this period of time is considered the income tax valley. So 3 specific strategies for you to take into consideration. The first strategy is the Roth conversion. So Roth conversion is transferring money from a tax-deferred account, such as an IRA, into a Roth IRA. You pay tax at the time of that transfer or conversion. And the benefit of the Roth IRA is that the money grows tax-free forever. So if you are in a 0% tax bracket, you can fill that up and maybe fill up the 12% tax bracket with Roth conversion. Strategy number 2, capital gains. So the IRS taxes long-term capital gains at 15% at the federal level. If your income is low enough, you're potentially facing a 0% capital gains tax rate. Specifically, if your income is below $96,700 for married filing joint, your capital gains tax is 0%. So if you have a taxable investment account that has highly appreciated stock, you can realize these capital gains or gain harvest, as it's called, at a 0% tax rate. As long as you maintain income below that threshold, you will not pay any income tax on that capital gain. So obviously, if you retire early, you need income. You need something to help pay the bills. And you could potentially live off of highly appreciated stock in those early retirement years and be able to pay 0 income tax on those stock liquidations. Strategy number 3 is medical insurance planning. So I talked about medical insurance planning in my Retiring Before 65 video. And there are medical insurance subsidies that you could take advantage of if your income is below a specific threshold. For 2025, as long as your income is below approximately $81,000, you could qualify for a subsidy or a break on your insurance premium. This is assuming you're not on Medicare yet, so you're not 65 yet. So as long as your income is below that $81,000 threshold, you could receive a break on your insurance premium. So Roth conversions, capital gains harvesting, or medical insurance premium subsidies are all pretty valuable strategies to consider as a part of your early retirement plan. But the planning work should be done well in advance. Theo and Cassie, there's 10 years away from retirement. And we're already looking at these strategies and how we're going to fill up their income tax valley. And if you want to look at your specific circumstance, please do not hesitate to reach out. And don't forget to subscribe to the YouTube channel by clicking the subscribe button below.